Hi, everybody. This is the Middle Class Investor, and it is January 31st, 2016, Sunday, about almost 3 o'clock, and we were looking at a chart of the S&P 500, and we had another up week. We talked about that last week, that odds favor some more upside, given that big reversal week we had, and that, in fact, did happen. So, let me zoom in a little bit on a. Let's go to a daily chart. Let's zoom in a bit so we can take a closer look at what we had last week. So we talked before about a couple of different ways this might go. We said we might test this low first and then bounce, or we might just kind of zigzag our way up. And then what you can see here is I've got this area right here marked as resistance, and it kind of coincides with this downtrending channel line here. So somewhere, right in this area, the market's going to run into a little bit of resistance and could either chop sideways for a little bit and then keep on rallying, or most likely roll over and we'll go back and test this low. It's kind of what the market does when it makes an extreme. A lot of times it likes to go back and revisit that low. Now it'll do one of two things. It'll go down and make a higher low, let's say here, or it could go down and make a lower low. And I would say the odds favor the lower low, just because this was a pretty dramatic sell-off here. And we've got a series of lower highs and lower lows, and so I think the market trend is attempting to change here. And so if that's the case, when you're making this first kind of big move down, a lot of times you'll retest these lows before you get a big correction. And probably the big correction is probably going to coincide with some, Fed free money deal. And that's why I wouldn't expect it to happen this time, but maybe the next time down. I'm on a daily chart. So let's talk about how that might look, just to kind of give you a heads up so that you know what to expect. Again, this is very typical for the market to move in this kind of a zigzag manner. You can see that it's gone up to here, so you might get a small little pullback and then a thrust up into here. So maybe Wednesday we'll hit this 1950 area resistance, and then potentially start rolling over again, something like that, and make a lower low down here below 1800. That's what I'm looking for. Now, if you're someone who wants to go to cash in your 401k and you haven't yet done that, we should get a big rally that will actually take out these highs and maybe even test up here to the top part of the downward channel. Remember, we do have this gap up here, and this gap kind of coincides with the top part of this channel here. So you could get a situation where I'll tell you what, let me kind of draw it, but not in too much detail, just so you get the idea. You could get a situation where we go a little higher here, up into this area, down here, make a lower low below our previous low over here, and then you'll get a really strong rally up into this area, a little pullback, and then probably up into I wonder how come my deal's not working. Probably up into this 2050 area, which coincides with this gap here at 2040 or so. Now, if you're in your 401k and you want to step to the sidelines and put your money in cash, or some of it in cash, this would be the area that you would want to wait for and do that. So this might be like in March, or it could take some time for this to play out. So certainly it's not something you have to run into your, log in your 401k on Monday and start making adjustments. Now, if you need a little bit more evidence, then you might wait. Here's the thing about more evidence, and I've mentioned this before. The more evidence you wait for, the greater the risk that you end up taking. So let's say that, let's get this right here, put this here. Let's say that this comes, it comes down, makes a lower low, and then it rallies really hard, something like so, and then up into this area. And if you weren't comfortable stepping to the sidelines there, then what you're waiting for then is a new low. Okay, so something below this low, and that would definitely give you what you need for a long-term trend change. And like I said before, the more evidence that you need, the more risk you have to take. So I don't know what the math is here, but if you were to get out right here, obviously you're taking a lot less risk than waiting for another 6 or 7 or 8% or whatever this is to below 1775 or 1750 to decide, okay, I'm gonna step to the sidelines. And there's nothing wrong with that. It's just you just have to recognize that that's what you're doing. Let's go back. Okay, we're on a weekly chart. Let's look at the volatility index. So we should see volatility continue to come in, which we have, which we talked about. If the market was going to be more bullish, that volatility would come in. And that's, in fact, what has happened. So volatility was down this week. Could probably go a little lower, maybe, below this low here, maybe even all the way down into this area before rallying again. But I think it's safe to say that it will rally. I mean, this looks like the first move out in volatility, and then we've got a correction here. The next move in volatility is going to take us well above this 57 area and probably into the 70-75 area, if I were guessing. Now, trading volatility is tricky. I mean, I wouldn't recommend that for this group. I don't even do that. There are some people that do that. Typically, what they'll do is they'll come in and they'll sell volatility. So there's instruments out there like the VXX, and so what you do is you wait for a big fear day like this, and then you sell options, at some level above this, and then as volatility comes in, those options gain in value. But that's a different topic altogether. I mean, we can look at the VXX. There's the VXX. So you can see this last move up in volatility, you could have sold up in here somewhere around 37.50, and as it came in, you could have bought it back, down here around 17.50. Same thing here. Let's say we make a new high here in volatility, maybe here. The trick is where, right? So it could be the volatility makes its way all the way up into here. And if that's the case, you need to be a seller up there. But again, I don't want to worry about that too much here. That's altogether a different kind of strategy than managing your 401k. Here is the 10-year Treasury yield. And you can see that we pulled in even further than we did last week, which we talked about. We talked that, even though this was a reversal day, the bond market sold off and yields went up. The bond market rallied this week, and so yields came in a little further, and we've still got this support zone here. You can see yields, they're already kind of below this area. I guess not yet, but you could see yields break this area and even maybe come into something just below this area right here before rallying again. If they break this area, then it could be that we're going to come down and test this low. But I don't know. I think this is a good, 1.9 to 1.8 area. We should see yields stop and reverse and start trending higher. Having said that, typically yields go down when fear goes up in the market. So it's kind of hard to say exactly how this is going to play out. But for right now, this support area is still holding. So you have to give it some respect. Let's look at the Wilshire. The Wilshire, I've been talking about how the Wilshire's got kind of a better look to it in terms of a pattern that's recognizable and tradable. So this is pretty typical on how the market moves. You get this kind of situation like so. That last line didn't come out too well, so I'm going to redraw it like this, and then rally up, and then rally down. So to me, it looks like the Wilshire is already making, there's nothing but lower highs here and lower lows. And the Wilshire is a pretty broad index. It's 5,000 stocks. So, I would say the Wilshire is probably a better one to look at than even the S&P 500. But the S&P 500 is kind of the boss. So we don't want to get too far away from the S&P 500. It's just harder to read what's going on in the S&P 500. So I went to a daily chart on the Wilshire just to see, what could develop there. And you got a similar kind of look, right? You got this kind of zigzag movement here, and that could take you up into this area here. Right? And then, it could take us like to here, and then we could have another zigzag. That's possible. Something like that. But the key is it going to make it back up to here? And I would say the odds are not looking good for that to happen. There's a lot of resistance right here in this zone at this 50% retrace area, and whether the Wilshire rolls over, right in here and goes down, or if it comes down and then makes another zigzag up and then goes down, the Wilshire is definitely looking like it's already decided it's in a bear market. So, and there's other markets like that. The Wilshire's not the only one like that. The reason I'm just sticking with the S&P 500 is because most of your 401ks and stuff will track the S&P 500. So it'll give you a better idea of where, what your money is doing. We could look at the United Kingdom, Germany, Japan. The UK has come down here and touched support and bounced. It could go, it could go a little higher here, or it could begin to roll over and start to make new lows. Again, it's in a downtrend. This is pretty substantial and pretty obvious looking downtrend. So I wouldn't necessarily be trying to look to go long the United Kingdom. If you look at Japan, remember Japan had that big support area. It never really kind of got there and then rolled over and is continuing to look weak, although we're having a bear market rally here. So bear market rallies, that is rallies that are counter trend, they're very sharp, very powerful, and you can get sucked into them if you're not careful. The reason these are so sharp and powerful is because traders are short here. So, there's traders that are taking short positions. Whoops. I don't know why that did that, but let's see if we can straighten it out. And so there's traders taking short positions. It's not going to allow me to do that. So there's traders taking short positions all along in here. And then when the market reverses hard like that, they have to cover those short positions to protect their profits, which means they have to buy back their short. And this has the same effect as just buying stock. I mean, that's essentially what they're doing, which drives the market up very rapidly and very powerfully. And to someone who doesn't understand what's going on there, it could appear that, wow, the bulls are back in control, but that's not really what's happening. What's happening is the short guys are giving up on their position, and they're buying back, which is causing the market to go up. Germany also looks down. I mean, if we were to take a longer term look at this, the 5-year, I mean, this trend line goes back to 2011. We clearly broke it, retested it, and then sold off. So it looks like Germany wants to go down and continue to go down here. So again, I wouldn't be looking for long positions in these markets. I'd be looking for a place to go short or to get out on bounces. And right now, the bear market is very, very subtle. There's not a lot of there's some fear, but there's not a lot of fear yet, and so there's still people talking. Well, this is a correction. We haven't had a correction, and there's still some of that talk out. And of course, as you get a bear market bounce, more of that talk happens, and gets the less attuned investors pulled back in, and of course they get their faces ripped off and lose a bunch of money. So here's the ES, which is the S&P 500 futures, and you can see we've got a fairly clear Elliott wave type pattern here, a 1, 2, 3, 4, and 5, which would suggest that we would see, now this could go a little higher first. It could, kind of come up in here, but it's suggesting that we need to make a lower low here in a wave 5. So this would be like a wave 5. And, then you get a really strong bounce, usually back to the previous wave 4, a pullback, and then we'll start looking to close some of those gaps up there around that dotted line. The gaps are, I guess they're right here. I guess there's a gap right here. So let's say a gap right in this area. And maybe there's another one. I can't remember why I drew that dotted line. But anyway, we've got some time here. You got some time to kind of prepare. Of course, I know that one of the things you're going to be doing is you're going to be watching me to see, does this actually play out this way? And I'm really hoping it plays out this way so that you will increase your confidence in a little bit about what I'm talking about, because otherwise the losses could be significant, and you're just kind of left with, there's nothing to be left with but regret when that happens. Here's the FTSE, same kind of thing we were just looking at. Got a little bounce happening in the FTSE. There's a gap right here around 61.95. Probably what's going to happen is we're going to close that gap. Let me draw that gap here for you. The gap right here on the FTSE is right there. So you're likely to see this go up and close that gap, which would be to that 6,200 area, and then probably see the FTSE roll over. At least roll over into this area and then bounce and make a higher high up into this area. But those gaps, the gap tends to pull the market like a magnet. So I would look at that gap as the first line of interest if you're trading the FTSE. If you're in the DAX, there's also a gap here on the DAX up here around 10,711. Would certainly be an area I would look at to fill before going lower again down to this DP area. Now you can say, well, maybe the DP area is over because we already came down here and bounced above it, and that's possible. But a lot of times these DP areas, they tend to the market tends to want to go to those too before they really bounce. So it's just a probability thing. I'm not saying it's definitely going to go down there. I'm just saying that likely what will happen is this gap will close and the market will continue to fall into this decision point area before bouncing really strong. So again, I tell you these things so you can look and observe and see if my feel for the markets is something you want to continue to watch. Let's look at crude oil. Crude oil it doesn't look like it's been bouncing, but the last couple of weeks, crude oil has been trying to bounce a little bit. I think this is going to be kind of a false bounce. I think we're going to probably make another lower low. It might not be that much lower, but I think this is kind of a false little head fake here. Only because it seems like it would have been stronger than this by now. So I'm kind of expecting it to maybe go a little higher and then roll over and make a lower low. And then somewhere in here we're going to get a pretty good bounce up into this 65 area. So maybe we're already there. Certainly you could enter a trade here. Let me just show you how you do that. You could say, okay, this is the low candle. So you take that as your trade candle, and you bring your target up here to just around 65 area. Of course, you can see the risk is exceeded because we're on a weekly chart. If we went to a daily, that's probably a better place to take that trade. And you can see here we probably already would have been in it, but if you wanted to take I wonder how come that's not showing up. Let me go back to the weekly real quick. My decision point is not showing up on the lower time frame, which is a problem because that's where the target is. So let's pull the weekly up just real quick. I'll put a new decision point on there, and then we'll look at the daily and see if there's a USO trade. Or USO is the ETF for crude oil. It's a real easy instrument to trade, just trades like a stock, and then you don't have to mess with the futures. Okay, finally it came back up. So let me take this decision point off. Really, your initial target probably should be here because this is the next swing. So let's put that up there. Let's remove. And let me clear all and then put it back up there. Okay. Put that there. Now let's go back to the daily, and we should be able to see a trade set up there. Yeah, there we go. So what you could have done, and you still might be able to, if the market comes back down below here, which it's likely to do. Remember I talked about how it likes to retest. So let's say it retests this area right in here. Then what you could do is you could enter a trade off this low here. Off this low, and then a target up to here. It still says risk is exceeded. So anyway, this risk I have at $20,000 at 2%. So on the USO, it's probably you could probably get a trade to set up. This would have worked better had I been ready for this trade, let's say, because normally what you would do is you would just trade off this candle here. Your high and low would be off this candle here, and then you would take a target up there, and you can see that's 14-1. Again, the risk is exceeded, so you might have to take a little bit more than a 2% risk here on a $20,000 account and just trade one contract. But you can see the reward is pretty great. I don't know what that would be, but that's pretty significant trade there. An easier way to do it for middle class investors is look at the USO. The USO is the, you can see here, it's the United States Oil Fund. It's an ETF, exchange traded fund. And you can see here that that oil on a daily basis has broken above this high. So we've had a close above this low day here. And, probably what will happen is sometime during the day, on Monday, you'll get a pullback into this area. You could enter, and you want to trade oil, if you're going to trade it, into this area right here around 1750. So let's say, what is that, 925 to 1750. It's a pretty good trade. So for those of you interested in trading oil, getting into an oil position, you might look at that. Let's go back to, do I have anything else at NinjaTrader that I want to look at? There's really not anything else there. We can go over here and look at, I got crude oil here, but let me look at gold real quick. And we'll look at the dollar too. So gold, finally showing some strength here. We put this other decision box off this pivot low here. So what I was looking at, and I realize these pivots are probably a little bit confusing for you guys because it just takes a while to look at them. But you can see the market went down to this low, and then it came up and zigzagged, right, like this. And so this is all one move up right here. So I go back to the last pivot swing, which is right here, and then I create one of these decision boxes. And it's a zone, right? That's why it's a box and not a line. So the market came down, kind of retested. It looks like it's wanting to take off. So, we'll see. I think it's possible that oil comes back even to here again before it takes off again. So, these bottoming processes, these are very large patterns that are happening. And so you got to give it a little bit more wiggle room. And keep in mind, this is a weekly chart here. So this whole pattern right here is kind of a bottoming pattern. So gold is, the MACD is starting to curl up right here. This market action's looking pretty good. I still think it's a good area to buy gold. I've been saying that now for a few weeks. So you could also buy silver in this area as well. The dollar, though, continues to look strong. And so this is why I say that you could have gold pull back in the short run as the dollar tends to grind its way, up into this area. So gold could have a new low in its future as the dollar climbs higher, and then, look for the dollar to pull back pretty significantly after you reach this area up here, because the dollar's had a pretty big run here, and it could come all the way back into this 90 area, low 90s, before it continues to rally higher. So just keep an eye out for that. Since I mentioned silver, let me pull up silver real quick. Whoops, hit the wrong button. That always is frustrating. So you can see silver. You can kind of see here that this is a little bottoming. It's a little bit more obvious here because you got this kind of rounded bottom thing going on here. So silver's trying to put in a bottom too, although it could come down and make a new low. That's certainly possible. But this is clearly indicative of some bottoming action. And anywhere, if you were in the market for buying silver, physical silver, anywhere in this area would probably be an okay area to buy silver. If you want to risk it and see if silver pulls back a little further, you can certainly do that and save yourself some bucks. Right now, silver, the low is 1362. I thought this was kind of the bottoming action a while back, so I bought some silver back in here around $15, $14.80, something like that. So my silver's a little bit underwater right now, but it's really hard to buy it. Buying physical silver is not the same thing as trading, and so it's really hard to pick the right spot. That's why you need to look at a really big trend, which we've been doing, and this is a pretty good place for the market to pull back to. Now, ultimately, I think silver is probably going to go. In fact, let's just put that box there for now. We're probably going to visit this area here before it's all said and done. But I think I mentioned that you might not be able to buy it there. It might, as it becomes less profitable to produce, you might have production cut back. Commissions to buy the physical metal could kind of skyrocket, and so you're getting a good price, but then you're having to pay, instead of $1, $2 an ounce in commissions, maybe you have to pay $6 or $8 an ounce. So you never know what's going to happen with the physical metal market. So you need to just pick your place. I mean, certainly if you're trading futures, you can wait for a deeper pullback. But I think we're going to have a pretty good rally in silver somewhere in here, and it's likely to take us, back into an area around $25 before we head down real low. So, and that's just what the chart looks like. I don't know anything about physical silver and what its ability to their ability to produce it or anything. It just looks like to me the chart can meander its way up here to the $25 mark and then roll over and probably head down as low as this $6-7 area. Maybe even lower, maybe right around in this area about $6.50. So with that, I think I'm going to end the program this week. Don't have much to say. I posted a video online on my channel with Ray Dalio on CNBC, and I think Ray's a hedge fund guy. He runs some hedge fund. I forgot which one, but he's talking pretty candidly about money flows in the world economy. Now, he's not saying it directly, but he's kind of alluding to some of the problems, some of the you hear him talk about structural problems in our economy, and he's kind of alluding to that with talking about China and money flows. And this is what you've got going on. It's not really the market is just kind of responding to these imbalances that we have in the world economy. And the nature of imbalances is that they tend to move toward balancing out, and that balancing out is likely to produce deflation here in the U.S. And so now he doesn't say that. He doesn't say deflation, and he doesn't say crash or anything like that. But if you listen very carefully, he's talking very cryptically about some of his concerns. And to my knowledge, it's the only. Now, I don't sit around and watch CNBC all day, but I just watch it in the morning when I'm getting ready, and I have heard no one except this guy, no one that's on CNBC. Now, Peter Schiff used to be on CNBC before they ran him off, but I haven't heard anybody of late even allude to any of the things that this guy is talking about. And I think he's spot on, but he may be the very first guy to be talking about this on the major networks that I've heard anyway. Now, sometimes Jim Rogers comes on, Bloomberg and things like that, and I don't always catch that. But this, if you haven't watched the video yet, watch the Ray Dalio. It's the one with the CNBC lady Becky Quick on the YouTube introduction panel, and listen to that guy talk, because there's some very telling things in his communication. That was during that Davos summit, where all the bankers and the central bankers and all these do-nothings meet out in, a beautiful place up in the Alps around Spain, between Spain and Italy. And, or not Spain, where is Davos? Davos is like in Switzerland. So forget about Spain. It's in Switzerland. And it's a really pretty place, but those people all go up there and they kind of jawbone different things. And anyway, watch the video. I think it's pretty interesting. I also put a video. There's a guy named Jason Stapleton who I podcast, and he had an interesting talk about China and just overall economy stuff and how you can't suspend reality forever, which I completely agree. So watch those 2 videos if you hadn't. I think you'll enjoy them. And other than that, we are pretty much done for the Middle Class Investor this week. And I guess until next week, you guys take care. We'll see you then. Bye-bye.